whenever there is a merger happens of two companies. Okay. So, can you read, Nandini? So, there is an acquirer and there is a target company. One company wants to acquire another company. So, the company who wants to acquire is called the acquirer, and the other company is called the target company. Okay. So, the exchange ratio is decided, how many shares will be offered for of the acquirer's company share to the target company's shares. Okay. Because there are two companies, so acquirer is going to give shares to the target company of its own companies, fine. So number of shares offered depends upon the valuation of the target by the acquirer. So the company which is being acquired needs to be first valued. What is the value of the share? Now, sometimes what happens, the value can be seen from the stock exchange. Okay, what is the value of the stock of that company? So sometimes if it is not a listed company, we can always work out the value of that company based on various parameters. And even the value which is given in the stock exchange may or may not be the real value, because we all know that the value which is given in the stock market is either overvalued or undervalued at most of the times. Okay, they are never fairly priced. If the market is very optimistic, all the shares will go up at a high price. So that means the valuation of the acquirer, valuation of the target has to be done first. Suppose I want to acquire, say, a building. So first of all, I want to know what should be the value of that building, isn't it? Then if I know it's worth so much, I can pay it and acquire it. So this is the same thing. The acquirer is going to acquire a company which is called the target company. Okay. Now, for example, recently in 2022, SDFC Bank and SDFC Limited announced a stock for stock merger. Okay, it's called stock for stock because the companies are SDFC Bank is going to issue shares to SDFC Limited. So, as per the terms of the deal, shareholders of SDFC Limited will receive 42 shares of SDFC for 25 held. For each 25 held in the of the target company, they will be issued 42 shares of SDFC Bank. So, this was a swap ratio which was decided at the time of the merger, which the merger is already ongoing. Okay. Now, again, if you look back, old one, ICICI Bank in way back in 2010 acquired Bank of Rajasthan. Okay, announced a stock for stock merger where the ratio was fixed. It was 1:4.72. That means for each one share of ICICI, for each 4.72 shares of Rajasthan Bank, they will get one share of ICICI. Is that clear? Now, how do we calculate the swap ratio? How this is determined? Okay, so what's the process? To arrive at the exchange ratio, both acquirer and target conduct a valuation of the target. Okay, so that means both the companies, the acquirer as well as the target company, they will do their independent valuation of the company, because the target company would like to get more shares, more money. Okay, because when you are going to buy a building, so you will say I can offer you 3 crores, other person will know it's 4 crore worth. Okay, so both will be doing a kind of a valuation. From the above process, the acquirer determines the maximum price it is willing to pay, while the target determines the minimum it is willing to accept. Okay, like in my practical life, I had some experiences of where I got involved into this process when I was working with Hero Group. So one of the company in America, place called Denver. There, it was company called it was a bank basically. So they wanted to acquire our company. Okay, and so we all sat together and did this exercise of valuation exercise, what we demanded and what they were willing to pay. Okay, so within this range, the actual agreement price will be depend upon each party's others investment opportunities and relative bargaining abilities. Okay, now suppose that the target thinks that he's getting a better offer from someone, so he may have some opportunities. Okay, fine. And even the acquirer, he may have some more opportunities to buy something else than what he's thinking about buying. Okay, and all their bargaining abilities. So based on the valuation of the target, the acquirer determines the per share value it is offering to pay. Okay, so target valuation of the target, the acquirer determines the per share it is offering to pay. So he say, okay, this is my offer. How much I want to pay you per share of your share. Okay. The exchange ratio is determined by dividing the per share offer price by the market price of the acquirer shares. Okay. dividing by the offer price per share offer. Now he says, I'm going to offer you, say, 40 rupees per share. Whatever shares you have, I'm going to pay you certain number of shares. So it is divided by the market price of the acquirer's shares. So the company which is going to acquire, it will have its market price and the offer which is making, so it will divide and make calculate a swap ratio. So we'll understand there's a formulas there. So let's look at a practical example to understand that. So there are two companies, United Communication, who is an acquirer, and Dynamic Entertainment, who is a target. So the question will come in your exam, okay? Similar question. So if you understand this, then it will become a simple thing to solve it on your end term. So the net income of United Communication is 5 crore rupees and Dynamic it is 1 crore. So this is the profit of both the companies, the PAT, the profit after tax. Then the shares, how many shares each company has? So United Communications have 50 lakh shares and Dynamic has 20 lakh shares. Are you able to listen to me? I mean, the people who are online, are you all there? Is it there? I mean, or they're just logged in? Okay, fine. Is the online working? Are there students there? And I'm not mute there, no? Okay. So earning per share. Suppose the earning per share of the acquirer is 10 rupees and the target is 5 rupees. So that means the acquirer is earning at the moment 10 rupee per share and the target is earning 5 rupees per share. So EPS is given for both the companies. Stock price of both the companies are there, 150 rupees and 50 rupees for the Dynamic. Okay. Normally the acquirer will be a strong company and the target would be weak companies willing to be sold. Okay. Normally this would be the case. So the P ratio of both the companies are given. So the P ratio is what? The stock price divided by EPS. So 150 divided by 10, we get 15. So in exam, you have to even calculate the P ratio. So you know the formula, it's very simple. Okay. And the P ratio of target is 10. Okay. Now, let's assume that based on the valuation of Dynamic, United Communication has determined that is willing to offer 65 rupees. The share is trading at 50 bucks. So they're asking, 65 rupees. Okay. Assume that the United Communication has determined that 65 is the right price to acquire the company. So this is there is a 30% premium above the pre-merger price of Dynamic. Okay. So Dynamic is a company which is getting acquired and United is a company who's acquirer. So the Dynamics, is the target company. So they say that we'll pay you 65. So, the United Communication is saying that we'll pay you 65 rupees per share of yours. Okay, fine. So this is 30% over the price which is prevailing in the stock market or which is listing. So there is always a controlled premium, which the company pays because here the United is going to acquire 100% of Dynamic. So they need to pay something extra, okay, which is called the control premium because the control will be passed from Dynamic from the Dynamic to United or the company, okay. So always the valuation is done with a kind of premium which is normally prevailing in the stock exchange. If the stock exchange price itself is overvalued, then the premium will be less, okay. So in terms of United share, rupees 65 is equivalent to 65 divided by 150 because the acquirer share is 150 and the target share price offer is 65. Is that okay? So this will make the swap ratio as 0.43 is to 1, which means for every one share of Dynamic, for every one share of United, what does swap ratio tells me? Tells you, Abir? So swap ratio of 0.4 is to 1. So that means 0.43 share of the acquirer will be issued per share of the target company. जो टारगेट है उसका एक शेयर के ऊपर उसको 0.43 शेयर्स देना होगा ऑफ द acquirer company. Is that okay? Now, based on the preceding data, United can calculate the total number of shares that it is willing to offer to complete the bid of 100% of Dynamic. So there's a formula here, so which will be 65 divided by 150 into 20 lakh shares of the target company. Target company shares are 20 lakhs. In the first screen, the shares are given as 20 lakhs. Okay. So, if you go back here, the how many shares? 20 lakh shares, isn't it? Okay. So we calculate the swap ratio and multiply this ratio to arrive how many shares uh, the the acquirer will be giving to the target company of its own shares. Okay. Yeah. 65, you are not listening. That means, this was the offer made by the acquirer to the target company that we can pay you 65 rupees per share. Fine. So because, when you go and want to buy anything, you first give an offer to someone. Okay, I want to buy this for this. Okay, suppose you go to the market. Okay, like a market like, where you can always bargain, like a Sarojini market in Delhi, where you can always say that I'm willing to pay you so much of money. Okay. So he says, well, okay, I'm willing to pay you 65 rupees. So in that case, if they are willing to pay 65, how many shares will be issued? 8 lakh 60,000, 66,000 shares of United to Dynamic. Okay. In lieu of their 20 lakh shares. Is that okay? Is that clear? Fresh shares. Fresh shares of the acquirer, additional shares. Okay. No. Whatever shares they have got, they will be cancelled. Now because since who is the Dynamic is the company which is getting acquired, so it will get merged into the United, and they will lose their existence. Okay, this company is wound up, so all these 20 lakh shares will be cancelled, and fresh shares of 8 lakhs 66,000 shares worth of the United will be issued to Dynamic, and Dynamic shares will be cancelled, closed. No, no, no. Okay. See, listen, what is happening? There is a now in this case, United Communication is a company which is going to exist. Okay, they are acquiring 100% of Dynamic. Okay, so Dynamic company will their shares will be cancelled. Okay, that will cease to exist after it gets merged with United Communications. So United Communications shares will be 50 lakh shares will be there, but now they have to issue a fresh issue, okay, of 8 lakh shares worth, so that they give it to Dynamic, and all the assets and liabilities of the company will get merged, and there will be a fresh company, a new company with the same name, United Communications, with a merged entity, consolidated company. Okay, it's the same company. It's not a new company. It's the same company, but now those assets will belong to, like suppose you have one house, you buy another house, so you own two houses now, isn't it? So this way, United Communication is buying another company, so that company will get merged, and there will be a combined entity now. Okay, is that clear? So that's a good question. Okay, keep asking me. Fine. So how many shares will be issued? 8,66,666. To Dynamic shareholders, affiliate. So it's good that you clear all your doubts. Okay, fine. Okay, so this is a fresh share. So now, since we'll complete the exercise, we'll come to know, but keep asking. By the time we finish, you will be knowing everything. Okay. So calculating the EPS of the surviving company reveals the impact of the merger on the acquirer's EPS. Now, after this deal, suppose they accept 65 rupees offer, then how this merged entity will look like? Okay. Combined earning 6 lakhs. If you go back to the earning, you find that a company Dynamic is earning 5 crores, and company United is Dynamic is earning 1 crore, and United is earning 5 crores. So combined earning will be how much? 6 crores, and combined share outstanding will be 50 lakhs plus 8 lakhs, 58 lakhs, isn't it? So we'll just go back. So the total share outstanding will become now of this merged entry will become this much. So they have a profit of this so many shares. So if we calculate the EPS now of the combined entity, so pre-merger EPS was 10, okay, of the acquirer. Post-merger, it is now becoming 10 rupees 23 paisa. So we say that the example of there is an accretion in the EPS. So the deal is EPS accretive. So whenever your news comes, then they say that this deal is going to, increase the earning per share after the merger. So post-merger, the EPS has become 10 rupee 23 paisa as against 10 rupees of the company, United. Isn't? So what we have done is we have taken the earnings, we have divided by the total outstanding now and look at, how the EPS will look of the new company, the combined entity, okay, which is coming to be now 10 rupees 23 paisa. Then we say there is a dilution in the APS. So the next example is coming, okay, fine. So now, in case the dynamic rejects the offer and the offer is revised to 90 rupees. Now they say, oh, sorry, we don't want 65, but we want 90. And suppose if this is accepted, what happens? The exchange ratio will be 0.60 shares of the acquirer, which will be issued to the target company. The dynamic shares which are going to be issued now will be 0.6. The swap ratio is 0.6. So, please looking at the slide and you will understand because the slides are with you, so don't worry about it, okay? So that means now instead of 8 lakh shares, 12 lakh shares will be issued because now they are offering 90 rupees per share, okay? So they are paying more. So that means, the number of shares will go up. That means the fresh, issue of shares from United to Dynamic will go up from 8 lakhs to 12 lakhs because higher price is being paid. So more shares will have to be paid, okay? Fine. So pre-merger EPS was 10, as we know. The post-EPS merger will become now 6 crores of profit and 62 lakh shares, 50 lakhs plus 12 lakhs, isn't it? So 9 rupees 68 paisa is the post-merger. Okay, fine. So United Communications EPS decline in the following higher offer price. This is an example of dilution in EPS. So at times this can be, increase the earning per share of the company which is acquiring. At times, if they're paying a higher price, then it can be a dilution in the EPS. Okay, fine. If there is a dilution in the EPS, what will happen? The stock market will react to that and bring down the share price of the acquirer. So it is going to yeah, definitely. So it can be at times, the share market reacts to the news whether they say it is going to be EPS accretive, the share price is going to take up. If the EPS is going to come down, then the share price of the merged entity will fall in the market. Okay. So we'll do a question, you'll understand. Again, there's a question which will happen like this. In next question, which you have to do, it will exactly happen like that. Okay. Where you have to calculate this thing. Okay. Now, dilution of EPS will occur anytime. I'm recording it. I'm recording it. It's getting recorded on my system. It can't be recorded on Google Meet because then you should have a right for recording. Can you record that on the Google Meet? Just see. You can't record it unless you have the paid version of the Google Meet. So anyway, but I have got a version where I can record it. Okay, I have got a software which will record whatever I'm speaking and it will record all the slides, everything. Okay, fine. Then I'll share that recording. So let's look whether it's getting recorded. Okay, just look at it. So almost 19 minutes recording has happened. Okay, fine. Though chances is 100% it will get recorded. There is no problem. But at times it can, give a problem. So it's not guaranteed that it will get recorded, but 99.99% will get recorded and shared. So what I'll do, I'll put it in a Google Drive and anybody can access because they're a very important part of our learning because today students are less, but all the questions are going to come from today's session, most of it. Okay, fine. So dilution of EPS will occur anytime the P ratio paid for the target exceeds the P ratio of the company doing acquiring. So when it will happen? When the price earning ratio which is being paid is more than the P ratio of the company which is this thing. So we'll understand that. The P ratio paid is calculated by dividing the offer price by the EPS of the target company. Okay, the company which is getting acquired is a target company. Whatever offer you are making, so you divide this. So if it was 65 rupees divided by 5, then it was coming 13 rupees. And the acquirer's P ratio was 15. If you go back and look at what is the P ratio of the acquirer, of the acquirer and the target company, 10. So this we don't have to look. We have to look at there. Now offer price. What we have to do is we look at the offer price, which is so that means the P ratio of the acquired company is coming to 13, okay, even after offering 65, which is less than the PE ratio of the acquirer. So this is going to be a kind of a, this is accretive, okay. But where it is goes to 90, 90 divided by 5 is the earning per share, then it goes to 15, okay, which is, sorry, it goes to 18. So 18 is greater than 15. So the P ratio of the target company jumps up to 18 compared to the P ratio of the acquirer, which is just 15. So in that case, it will be a dilution. Is that okay? It's paying more price, okay? Fine. Here, higher PE ratio than your own ratio. If you're it's working like that, then it will bring down the earning per share of the company. Definitely, the market is going to react. We don't know, of course, if the market may sometimes surprise also, but most of the time, 90% the market is going to fall. Okay. If you are paying higher PE ratio compared to your own PE ratio, it's not good. It will bring down the combined EPS. So that's learning. Okay. Fine. So now you will do question. Okay. This will be done by your own self. Okay. Which one? Which one? This here? This one only? Huh. So here, what is happening is when they were offering 65, okay, if we divide by the earning per share of the same company, then the price, the P ratio was 13, whereas the target companies, sorry, the acquired companies P ratio is 15, which is greater. So if that is the case, then it's good news for the combined entity. The share price will go up, the EPS will also go up. But if they are paying very expensive, they are paying higher PE ratio. That means they are paying a higher multiple. Okay, they are paying, the company which is being acquired is valued expensive. Okay, compared to its own self. So the price is going to fall. Okay, fine. So listen to what I said last. Okay, if you are paying more, so you're acquiring, you are valuing the target company at a much higher price. Okay, so when you acquire more, then fine, you have paid higher money. So the earning per share will go, because the number of shares you are going to issue will go up and bring down the EPS of the merged entity. अगर आप ज्यादा प्राइस दोगे तो आपको और ज्यादा शेयर इशू करने पड़ेंगे, and what will happen, the EPS is going to fall. It's a simple mathematical trick, isn't it? Okay, if you do question, you will follow it. Okay, so which is this question? हाँ हाँ, rupees 5 is the EPS, the PE ratio of the acquired company, the target. If you look back 5 rupees here, so earning per share 5, 65 divided by 5. Here we were dividing 50 divided by 5, we were getting 10 PE ratio. But now the company is offering 65. The United Company, instead of 50, which is prevailing in the market, they are offering them 65. So 65 divided by 5, the PE ratio is going to go up to 13, isn't it? The paid PE ratio is 13. Fine. But it is less than the entity itself who is acquiring. So it's good news that they are paying less. They are valuing, company lower than themselves, okay? Because this is a strong company. This company is strong, that's why it's acquiring. So it commands a higher P ratio. This commands a lower P ratio. Assume that this company is not as strong. So any company which is not growing so much will command a lower P ratio. So try to understand the practical part. Now this company is trading at a multiple of 15 and this is trading at 10. So there can be, the most important interpretation will be that this company is stronger. So people are buying this company and pushing the share price of this company, and it is highly valued. Unless the second even thinking would be that this company is over expensive. It's not doing so well, but commanding 15. But that's not the case here. The case is that it is commanding 15, okay, against 10 because this company is stronger. So maybe it is having a good future in terms of growth, or it is less risky company in terms of a standard deviation of beta, whatever we look at to measure the risk of the company. So this company is having a P ratio of 10. Okay, so that means people are not buying it. They are not pushing up the price. That they don't think any kind of a strong future growth. So if this company gets a higher P ratio than this company, stronger company, definitely it's going to be a disaster for the first company which is acquiring. अगर ये 18 65 देती है तो ठीक है, फिर भी 13 ही आ रहा है ना. It's lower than what its own P ratio is. But if it pays 90, then they are paying 18. 90 divided by 5, they are paying much higher P ratio than their own self. So a strong company is paying a very expensive price to acquire a weak company. So which is not going to be good news. And the earning per share of the acquirer is going to fall. Is that okay now? Have you understood? It's good that you ask question, then it becomes a little better version. Have you understood, Veshaka? उसको ध्यान दो. When you ask a question, then listen to me. Instead of writing, you'll just forget what I'm saying. Okay. Keep listening to me. Okay. And then it's getting recorded. You can just listen to it again. So this is what is the right thinking. Okay. So let's go to a question here. Okay. So these are two questions: money and Ratnam. Okay. Profit after tax is given for the both the company. Now, these are questions coming from CA intermediate long back, about 20 years back. Okay. So number of shares, 4 lakh and 2 lakh, uh, P ratio 10 and 5. Okay. What is the swap ratio based on the current market price? So first you are supposed to do that. The second, what is the EPS of Money Limited after the acquisition, the acquirer's EPS? What is the expected market price per share of Money Limited after the acquisition, assuming the P ratio is adversely affected by 10%? Okay. Determine the market value of the merged entity. Okay. Calculate the gain loss for shareholders of the two independent entities due to merger. Fine. So first is, let's say maybe that I have just solved three or four, so we'll limit it to that only. What is the swap ratio based on the current market price? So what is the swap ratio on the current market price? So what you have to do is you have to complete this table first. First process would be that since a lot of information has not been coming, so you have to calculate the EPS. So EPS will be your 1 divided by 2. Okay. Now we have the EPS here. Second, the market price per share, because the P ratio is given, so you can calculate 3 into 4 as the market price. Is that okay? Then the swap ratio will be the share price of Ratnam is 20 and the share price of money is 100. So it will be 20 divided by 100 will be 0.2 is to 1. So that means the money will issue how many shares? 0.2 into 2 lakh shares of target, it will be 40,000. Is that clear? Just have a look. If you have any questions in this slide, ask. Don't worry about it. This one? So this is basically what is the operation. The capital is there. Into shares of the target. So first, ah, ah, yeah. No, 2 lakh shares will be cancelled. They will be cancelled, removed. In lieu of 2 lakhs, they'll get fresh shares of 40,000 of Money Limited. Huh? Money, yeah. Fresh issue. New issues over and above 4 lakh shares which they have. If their authorized capital is allows them to issue 40,000 shares, then they can issue it. No, no, don't worry about the authorized capital. I just use the word. So company's issued capital is 4 lakh. So company has to issue fresh issues, okay? Fresh shares. Fine. So if their authorized capital is also 4 lakh, they can't issue it, okay? So they have to go and make an amendment in the memorandum of association and file with the registrar and seek its approval before it issues 40,000 shares. So if you go by the Companies Act rule, okay? Huh? They have been diluted. Yeah. So they will, before this company money acquires Ratnam, they will seek the existing shareholders, a special resolution will be passed in the company, in the AGM, okay, and they say, okay, go and acquire. Fine, that's all. So if before they acquire, because they're going to pay shares and they're going to dilute the existing shareholders' share, so they need to first get a special resolution passed in the board of Money Limited. They'll call annual general meeting or extra general meeting and then get it done there. Fine. So that is the legal process part of it. So we're not going into that at the moment in this. But it's good that you have asked. Yeah. 0.2 share. 0.2 share, okay. So 40,000 shares, okay, fine. Is that okay? This calculation, you just see the calculation. Is it okay? Abir, have you found? It's easy. So now what is the EPS of money after the acquisition? So look at this slide. Profit after tax, if you just combine them, so company money was earning 40 lakhs and Ratnam was earning 8 lakhs. So combined earning is 80. Number of shares 4 lakh 40,000. So EPS post merger will be 10.91. Okay, fine. Is it? And what was the EPS pre-merger? It was you look at the the this thing. Okay, fine. So it was basically, profit after tax. So it will become, 40 lakhs and 8 lakhs. So the combined profit will be 48 lakhs and the shares will be how much? 4 lakh 40,000. Isn't it? So that is what I put on the slide here. 48 level. So it will be 10 rupee 90 paisa. So EPS before the merger was how much? 10 bucks. And now it has gone up to 10.91. Is that okay? Fine. Because why it is happening, why it is accretive, if you look at the same rule, the P ratio of the company, target company was 5 and they've been offered the market price only. So paid P ratio is also 5 and the real P ratio of money is 10. So definitely it is going to be EPS accretive, isn't it? By going by the logic, the P ratio, the paid P ratio is also the same of the market price, which is, which is 20 rupees and the P ratio is 5 and the P ratio of the money acquirer is 10. So money is trading at a higher P multiple than the Ratnam. So, and they are paying exactly the same money. So it is going to be a accretive EPS accretive. Have you followed that? Have you followed? समझ में आया नहीं आया? Is it going? You follow it? Are you understanding? Very well. Okay, you can do it. हाँ हाँ yeah absolutely. Money will issue share from its own money. So now the total shareholders of money will be 4 lakh 40,000. Okay. Is that okay? So, so what is the EPS of money after acquisition? 10 rupee 91 paisa. Now, expected price of money limited post merger, because it was P ratio was 10. Okay. So if there was no hit on the P ratio, then the price of the market price of the share of say money would have gone up to 109 because it is EPS accretive. So the market is going to react. Suppose if the market gives the same P multiple, okay, then 10 rupee 91 paisa is the EPS and P ratio is 10. So that means the expected market price of Money Limited after the merger will be 109 rupees in the market. It will go up, isn't it? Is that okay? But in the question it is written that there will be a 10% decline in the P ratio for whatever reasons. Okay. So the market doesn't like this, kind of a merger because it is not going to benefit the money, maybe because of the business is such. So, the price will fall to 98.19. It is not that it is always EPS accretive, the market is going to go up. At times, when the market doesn't like this deal, in terms of, even if, the P ratio of 5 seems to be very high and they have paid it, they should have, negotiated and paid far less. So, or maybe the business are not complementary to each other. Okay, it is not going to bring more synergy to the company. Fine. More benefit to the company. So it may happen. There will be a lot of overlapping on the businesses. So some of the businesses have to be closed down. I mean, it has to be brought down because, they may have, like, when the Idea Vodafone was merged with Vodafone, then they had, a lot of places where they had, the spectrum, common spectrum. Okay. Or maybe they had, common, there was, I mean, there were two offices, so they had to close one office. So a lot of things were to be done basically after the merger, or there were some common resources or duplication of resources. So that can, instead of bringing synergy, it can, bring more cost also if they don't close that. If they close one office, it's simple. The cost will come down, but that is very simple. But if they have more wireless equipments or wireless, resources, which cannot be, sold to anyone, then it is going to be duplication of resources. So it is going to, the merger acquisition will not be liked by the shareholders, and it's just waste of resources. Okay. So it may happen like that. Okay. Because if suppose two companies are operating in two different geographic locations, then it becomes very good for the company. Then the company footprint expands. But if they're both working in the same geography, then whatever maybe the share price is not going to go up, isn't it? Yeah. So P ratio is coming from 10 to 9. That means the company money shares will be re-rated in the market, and it'll the shareholders will say 9 P multiple is good enough now for the merged entity instead of 10. It is because why it is falling, because at times the companies are re-rated. Even there is no merger and acquisitions, so the P ratios also fall. Okay, as the businesses grow or the business degrow, the P ratios keep depending upon the futures of the company. Fine. If the company has a great future, okay, company is growing at say 25% every year, but after some time it's going to taper down. So today the company may command a very high P multiple. People are all buying it, pushing up the price in the market. But people find now it's become a steady state company. Okay, it is going to grow at just 5%. Like, for example, Tata Steel, if you look at the P ratio, it's close to about sub 10. Okay, fine. Maybe it was trading at 20 at times, I don't know. But now it's trading at 10. So it's been re-rated because it's not going to grow, because there are other companies which are growing much faster. So people are going to buy them. So you'll catch a bus which is, doing better than the bus which is now slowed down. Okay. तो उनकी पे रेशो बढ़ जाएगी ना. New companies which are coming, which are going to do great business, so people are going to buy them, and people are going to leave those companies because those companies, old economy companies, have command always a lower P ratio compared to the new economy. Fine. So P ratios can come down for whatever reasons, because if the merger and acquisitions is not taken as good news for the shareholders of money, so they say now the company, P ratio has to be brought down. We will not buy it at this price. Okay, we'll pay lower price, a lower P multiple. Okay, so there will be re-rating of the P ratio. Is that okay? ये समझ आ गया? तो 98 हो गया. So market value of the combined, the last one, okay, the market value of the new company. So if it was going to be say 109.10 before the P drop, it was 4,40,000, the combined value, okay, which is 109 multiplied by the total number of shares, okay. So which is going to be 4 crore 80 lakhs. Yeah. Now I know 98. So if market value of both the companies before merger, market value of the new company, so we can always multiply with 98.19. You say if the P ratio up, this is the going to be the value. Fine. Fine. So you can mention both. Your observation is right. So we are saying, if the expected price is going to be, the P ratio is going to be 9, then the market value of the new company has to be valued at, at 98.19 rather than 109.1. So your observation is absolutely right. So you can even mention that, even that answer is right. You say that I have valued the company after the post fall of the P ratio. Okay? Ah. IPO का होता है जब कंपनी लिस्टेड नहीं है, तो कंपनी ऑलरेडी लिस्टेड है, इसका तो शेयर ऑलरेडी बिक रहा है. Okay, first try to understand the IPO is only for the first time when the company gets its share listed in the stock exchange. Here the company stock is already listed, so it can be either an IPO future, I mean, further public offering. Fine. So it's basically a kind of an FPO, you can say, or you can assume that company will not issue shares, fresh issue, because it's not going to profit or issue shares to only individual entities. So that is, they are not going for public offering. Okay, they are doing it private placement. Okay, Sarah. Okay, is that okay? No, not always QIB. QIB is only those 13 entities. Okay, fine. So they're not going to QIBs. QIB is not getting any shares here. Private placement, you are giving all the shares to one entity, okay, or any entity you want. Okay, maybe we need to check whether it will come under the SEBI fold or not. Whether such kind of things may, SEBI will say that you don't come under the IC regulations at all because you're not issuing shares to the public. Our regulations you are hit only when you are issuing shares to the public. Here the public is not getting any shares, but of course the public would be basically the shareholders of Ratnam, who may belong to public. So we need to check, under what ICDR regulations you are hit. Okay, that's a separate thing. We're not touching at the moment. The question is absolutely good, but at the moment that is not relevant. Otherwise, we can always look. You can always search for if there is an acquisition and stock for stock mergers. I mean, does the ICDR regulations get invoked in that? Okay, fine. Is that okay? Clear? Ah. Yeah, they will get fresh shares. Their shares will be cancelled. What will happen? The company will spread new shares, okay? Or maybe in the demat account. So they will, the demat account, those 2 lakh shares will be removed and new shares will be added. So now they will have in demat account fresh shares of Money Limited, and Ratnam Limited shares will be cancelled. So it will be removed from your demat account. Fine. Is that okay? Is it clear? So there will be a question like this, okay? Simple question like this, okay? Nothing more. Whatever I've given here, you have to just replicate, just learn it, okay? Fine, ke kaise karna? It's a simple formula. Sometimes if you are not able to follow the concept, no problem. You can just understand how I have to solve the question. A 10-mark question, 100, you will get it easily. Is that okay? Okay. Is there any question, further questions? How many students are there online? एक सेकंड कितने क्वेश्चन है? What one? This one? Huh? 25. Are they hearing? Just ask them. They are able to hear me. Are you able to hear me? All the students who are online. Yeah. Are you able to hear me? Ishan, I'm not able to hear you. You're all mute basically, I think. Yes, sir. Okay, fine. Yuvraj, yes, sir. Okay, fine. Okay, fine. I just wanted to make sure that you're hearing. Though I'm recording, okay. So is this clear? If you have any questions who are listening online, they can raise it on a chat line. Nandini, just keep a watch if anybody asks a question, so you can just let me know about it. Is that okay? Is this clear? Yeah. Huh? 10 is the price earning ratio of money. If the company may be trading at 10 itself, so we say what is the expected price after the merger? If the company is still trading at 10, the price will be 109.1. Company's money limited P ratio was 10. So whatever is the earning per share, it is trading 10 times than its earning per share. Okay. So we just simply multiply, calculate the market price of the share. Fine. And is that clear? Okay. So अब हम कर रहे हैं. Now we just close down. So this is all about the swap ratio, and there will be a question, practical question. So we have to move quickly. We move to the second part, which is leasing. Okay. So there's going to be a practical question on leasing. Okay. So first we're going to understand a little bit of theory. Okay. Are you able to see now? You're getting the new screen on this thing. So I put leasing now. Just check whether I have sharing the slide. Okay. So lease financing. Okay. Fine. So today we have to cover the swap ratio, lease financing, and the practical question which I have shared. So we'll try to understand that, and maybe if time permits, a mutual fund, a little bit about mutual funds. Okay. Fine. So lease financing. Okay. Can you read? What's your name? Suchita, sorry, I forgot. Suchita, yeah. Just read. अब इसको अच्छी तरह समझ लो. Okay, Suchita? Okay, so it's a written agreement between the two people, the lessor and the lessee, okay, where the equipment or anything is exchanged, okay, fine. Where there is a let out process happen. When you go to and you're looking for a house, you take it on lease, okay, there's a landlord who's called the lessor and the tenant who's called the lessee, okay, fine. Is that okay? A simple, whenever you're looking for, suppose a PG house or any house you're looking for rent, so this you can enter into a lease agreement with the landlord. The landlord will be called the lessor, and the tenant is called the lessee. Okay. So the lessee pays a rent to the lessor, and for lessor he gets the rent from the lessee. Simple. Okay. Okay. So here the lessor remains the owner throughout. Okay, the lessor is the owner. He's just giving it on rent to someone. Okay, so lessee is just enjoying that asset. Okay, because he's using that asset for the time being. A simple example of like you take a house. Okay, so you are a tenant, so you are a lessee and you are just enjoying the occupation of the house, and the lessor is getting a rent. Okay, fine. Okay, please read this. So read. This is very important. Okay, just pay attention here. Okay. Okay, now the smaller companies, because if they buy an asset, they have to shell out a huge amount of money. Okay, so instead of taking a some asset on by outright purchasing it, you take it on lease. The small firms always do that. Instead of buying, they will go for lease. Now, similarly, yesterday or day before yesterday, we were having a meeting of our Resident Welfare Association. So I'm the secretary for that. So our president, vice president, secretary, we all met, and we called a guy. He was supposed to put up boom barriers. Like for any gate, there is a boom barrier which will open up as the car enters. Okay, we already have boom barriers become old, so they are automatic boom barriers which will sense the car number and open it. If the car number is registered for the car owner is staying in our place. So they were offering us a lease. They were saying, okay, pay us 5,500 rupees per month for each boom barrier. So we have about, I think, 30 boom barriers we have to put because there are 13 gates in our colony. So, he was giving an offer to us. So then I asked if we want to buy outright, what will the price? He said going to be around 2 lakh rupees. So he said, okay, I should share the details and then we'll work out, which option we are going to use. Either we'll buy it or we'll go it on lease. So that is what you are going to understand today by taking a question whether you should buy it or take it on lease. So which is more better for a company. Okay. So this is ultimate the whole target for the day. Okay, read. The last one, please focus here, the last paragraph, okay? Just read it. Okay, now whatever lease rent you pay, it becomes your business expenditure and you can claim it as an expenses, okay? So they are tax deductible. Fine. So you show it as an expense, the company has to pay lower tax. Okay, if you're paying a lease rental, say 5 lakh rupees per month, so you paid 60 lakh rupees for the whole year. Okay, and if you are suppose assuming that you're under 50% tax bracket, so you're saving 50% tax. Okay, so your 50% tax will get reduced because that's a legal expense you can claim while from your turnover and for calculating your net profit of the company. Is that okay? Is it clear? Because that is what we are going to use the concept. Yeah. What is the point? Okay, just hold on. Just move forward. We'll come to a question, then the answer. So it doesn't require any explanation because after all, you can either buy it. If you buy it, what do you get? You own it. Yeah, that's again a good question. You buy it, you get depreciation, which is again an expenditure. Okay, fine. So instead of getting depreciation, because when you're buying when you're taking on lease, you will not get depreciation. Depreciation will be enjoyed by the owner, isn't it? Not by you. Okay. Of course, there are a lot of changes which happen to the international accounting standard for lease, where even the lessee can take the depreciation, but we are not going to confuse. That is only for companies like book writing. For income tax purposes, it is an expense and you can claim as an expense. Okay. We are not going to just have a mix up two. Now, in this, there is a lessor. Suppose there's an equipment supplier. So, suppose you want an equipment. If you're doing a business, you go to the equipment supplier, you say, okay, I like this. Then you go to the lessor, who is a financing company. You say, I want this. Like suppose you go to a car showroom and you say, I want to buy this car. This is worth 30 lakh rupees. So you'll go to your bank who's going to finance the deal, who's a leasing company. So you say, okay, I want. So the asset will be delivered to you, and you are going to pay a rent, and he's going to pay the amount upfront. So whenever you acquire a car and you have to pay it on an EMI basis, you do the same process, isn't it? The same process is kind of a same process is explained here, but it is a lease and not you're not. I mean, that is a hire purchase, so it's a lease. Okay, fine. So here, the equipment supplier, you will approach to the equipment supplier. You'll say, I want this, but then we'll go to the leasing company. You'll say, I want this. So he will pay the full price to him, and you will pay a rental to the lessor. Is that okay? Now, lease financing. Okay, read this. Now, if you approach the bank for taking a loan, suppose you like equipment which is say 50 lakh rupees worth. So you have two options. Either you can take it on lease, or you can borrow the money if you don't have from the bank and then buy it outright. Now, when you go to the bank, he may ask you so many things. He'll ask you give us, last 3 years profit loss account, give us your balance sheet, who are the owners. It's a company, they'll ask, 100 documents, and will take their own time. Maybe they'll take about 2 months to clear your loan. But leasing is much faster. If you go to a company and say that I want to acquire it on lease, it may be done in just a matter of just few days rather than done on a month if you are going to buy it outright. Okay, so it is much faster and easier to approach and take it on lease rather than taking a loan. Okay, fine. But anyway, some companies take it on loan also. Okay, fine. So now there are two kinds of lease. Okay, operating lease and financial lease. Very, very important. Sometimes during your interviews, if sometime happens you're talking about lease, so they'll ask you a question. What's the difference between operating lease and financial lease? So this is a very, very important question which are being generally asked during your placement offers. Okay, if you happen to be a finance student. So operating lease. Now there are two kinds of lease. Now suppose, for example, you want to take a car on hire, or suppose just take an example that you are running a kind of a call center. Okay, so you are doing a call center business, so you have 100 agents, so you require 100 computers to be put on their tables, okay, so that they can interact with the customers and see this thing. So whatever the computers or whatever the equipments which is designed to give them all the information, so they're going to buy that. They need those equipment 100. So let's take 100 computers. Okay, suppose they're only processing data, so they require 100 computers. Now the company may acquire it outright, purchase it. Okay, that is by buying. They can go to a person and say we want it on lease, operating lease. Why? Because operating lease is always short term. When you're buying it, you buy 100 this thing. It says okay, 2,000 rupees rent per computer. Fine. And after 6 months, you find that your business is not doing so well. You can return 50 computers back to the seller, because you can downsize your call center seat size and you can make it 50 if 100 is too high for you, or you can even expand it. Suppose you want 200, so you say give me another 100. Okay, so you can always you can always if you want to downsize, you can return back the computers. So now, from that onwards, you don't have to pay rent for the balance computer. So that kind of a lease is called operating lease. Again, like hiring shamianas. Whenever you're having a marriage party, so you hire a shamiana for one day and you pay a rent for that, isn't it? You don't buy it because you don't require that shamiana for later stage. So you have to take it on operating lease. So operating leases are very short term. Okay, they can be cancelled at any time. Whereas financial lease are long term lease, and where the intention is that you want to buy something on lease, okay, for the total economic life of the asset. Suppose the asset life is 7 years or 5 years. So you say, I want it for 5 years. Okay, fine. And you can't cancel. The lessee cannot cancel the lease. Neither the lessor can cancel the lease. Okay. And generally the lessor will say that after the lease time is over, you can keep the equipment and pay me the salvage value. अगर उसकी जो scrap value वो दे दो, keep the asset with you because you have already used it for the full economic life. The asset, there is nothing but there is always a scrap value which is left. So he gives an option that you can even buy back the equipment after 5 years. The lessor remains always the owner till the 5 years of the lease, long-term lease, or 7 years, which is the economic life of the asset, or maybe 10 years, whatever time frame. And then the lessor says that, okay, I'm giving you this asset. So he's going to recover all the cost which he has spent along with some profit on that. Whereas in case of operating lease, he's not going to cover everything from you because he knows that he can take back the asset from you because you're going to surrender it and going to someone else. So let's understand, this. Okay, just read, we'll read because I've already explained that. Abir, can you read? Because the lessor is the owner, he'll maintain those computers. If anything happens, he's going to repair it, not the lessee, because it doesn't the lessee is not the owner. Okay, here it is given only for short term. If you take a shamiana from someone, he's going to provide you, he's going to upkeep the shamiana if he's put somewhere else. So he's going to, if suppose it is stone, he's going to stitch it again and put it somewhere. So the operating lease is always small. All the expenses of maintaining and ensuring the good remains with the lessor and not with the lessee. But in case of this thing, sorry, okay, operating lease, okay, fine. Read. Yeah. For example, if you require a car. Now I come on a car, which is a cab basically owned by someone. Okay. So the university is paying some kind of a money to him for per trip. Okay. Fine. But that cost, whatever I'm paying for whatever time I'm using, it's not recovering the cost of the car, isn't it? It's only for a short period of time. And university can always cancel the contract of the, travel agent and engage another one, isn't it? So it is an operating lease. Is that okay? Fine. It is callable. That means you can call the equipment back. If you're given some computers on, this thing, you can call those equipment, say, sorry, we don't want further any agreement. So please pay if you're not paying the rent. You may call those equipment. That's why they're callable. Okay. The lessor can call the equipments back. Similarly, the lessee can also give the equipment back to the lessor anytime he wants. Is that okay? Now, operating lease, yeah. So wherever the technology is changing fast, you would always like to take it on operating lease. Fine, fine. Instead of taking a finance lease. Okay, fine. So financial lease, non-cancelable. The lessee. So that means the lessee is going to bear all the cost. He is virtually actually the owner, though legally the owner is lesser, but he is owning it till the economic life. So he's going to maintain, he's going to repair it, he's going to upkeep that asset. Okay, instead of a operating lease, the lessor was doing the same job. Is it okay? Fine. So now these are the various differences between operating lease and financial lease. Just read them. I'm just going to keep it for 5 minutes. Read it, and there can be a theory question differentiate between financial lease and operating lease. Okay, just read it. Financial lease is that you want to simply own that asset. You don't buy it, but you want to still buy it, but you want to pay rental because you can't pay money upfront to someone. Okay, but you want that it should be, you should own, you should maintain it, it should be your own asset. Where operating, you don't have damn care of the asset. You say, okay, after 2 days I'll return it back. Fine. So read this by Abhi. or just read it. You want to ask question. You want to go out. So then you can watch the video or just sit, relax. Fine. For 10 more minutes, we'll do a question which is very important. It's going to come in the exam. And next 5 minutes. Fine. So read this. This is very important. Whatever we have explained, it is part of your. This can be your exam question. Okay. Differentiate between financial lease and operating. It's simple. It's coming out all what we have studied so far. Now we come to basically we skip all things. All is the same repetition. So I'm just going to the question straight away. So, because all what theory which is mentioned before that, there are new ones, so old one I retained it, so it's talking about the same thing, nothing new. So look at this question. Fine. Can you question for 10 minutes? So this will complete your part. Rest you can ask from Vishal. So just read it, Vishal. XYZ Limited requires an equipment costing rupees 10 lakh. The same will be utilized over a period of 5 years. It has two financing options in this regard. First is agreement of loan of rupees 10 lakh. अच्छा एक second. You can take some family plan or something. Are you having some fever or backache? Yeah. You can take some. Just give me the reading. So in 5 minutes you will have a break. 10 minutes maximum. Fine. First is arrangement of a loan of rupees 10 lakhs at an interest rate of 13% per annum. The loan being repayable in 5 equal years and end installments. The equipment can be sold at the end of 5th year for rupees. Okay, just hold on. X Limited wants to acquire an equipment costing how much? 10 lakh rupees. Fine. They are going to utilize it over the 5 years. So it has got two options. So the economic value of the asset is how much? 5 years. The equipment costs you 10 lakh rupees. Now, first option is that they can take a loan from a bank. So when they take a loan, they have to pay 13% interest, and it has to be paid in 5 EMI, year-end installment. But normally it's always EMI, which is equated monthly installment. But for simple sake, they have 5 equal yearly installments. Okay, they can always convert to monthly also. The equipment can be sold at the end of the 5th year for 1 lakh. So that means the scrap value of the equipment is just 1 lakh. Suppose that's the residual value of the equipment after 5 years, because after 5 years the asset is not going to finish, not going to value. So it can be sold at 1 lakh. The leasing equipment leasing the equipment for a period of 5 years at a rental of 3,30,000 payable at the year. So if you lease it, you have to pay 3,30,000 rupees per annum as lease rentals. The rate of depreciation is 50% on a written down value basis, and income tax rate is 35%, and the discount rate is given to you. A discount rate is given to you 12%. So we'll use how we use this discount. Advise which of the financing options should X Limited exercise and why. Question is whether they should take it on lease or whether they should take it on hire. So this question is there. Okay. So we'll go to an Excel sheet straight away. Okay. But in your exam, maybe the Excel sheet you will not be able to use. But there will be some data given. You can just calculate it on manually also. Okay. So I'll tell you how to do it manually. In case if there is some issue of, are you providing access to the Excel sheets in your exams? Okay, चलो कोई बात नहीं देखते हैं. If they are given, they're wonderful. But what happened was there was only one question that will be on Excel sheet. So there's an issue in the last exam which I gave somewhere else, but not in Shivnadar, because they said either all the paper has to be on Excel or it can't be just a combination of two. Okay, so same question. Now just look at this table. What we have done that if the equipment a company takes a loan, okay, so how much EMI they are supposed to pay. Now how I have calculated the EMI, the life of the equipment is how much? 10 lakhs. Okay, and what is the rate of interest? 13%. Okay, and it has to be paid in 5 equal installments. So first is using Excel. So I'll put my a cursor here just to explain. I have worked out that EMI is going to be 284,000 per. They are going to 5 EMI installments. So how we have done it? So if I put the cursor, so the formula is PMT. So I'll go to formula, okay, and go for recently used formulas. So I have got PMT. Are you used to PMT formula? PMT pakda. PMT is nothing but annuity. The rate of interest is how much? 13%. Okay, fine. And NPR is how much? 5 years. And the Present value, how much you are going to pay today is going to be 10 lakhs. Fine. Or rather 10 lakhs, not minus. So here we can put 10 lakhs straight away. Okay. And I just calculate here. So it is coming to 2,84,000 installment. Is that okay? So if 2,84,000 is paid, minus lay because installment you're going to pay. So that's why no, you don't have to write minus, you have to put the normal number. But actually, when you're taking a loan, the money is going out of your pocket. How much? 2,84,000. That's why I written in red. You don't have to do that. You have to just put 2,84,000 while solving, or you can put minus here, so it will come positive. If you look at the formula, I put minus here. Okay, so it is coming positive. Okay, fine. समझ आ गया? अब now if suppose you can't do it using this formula in your exam, now there will be something given, present value annuity factor table at the rate of 13%, 5 year is 3.51. ये फिगर दी हुई है आपको एग्जाम में. तो आपने क्या करना है, you have to simply take the total loan amount, okay, and divide by this number. You will get the EMI 2,84,000. अब ये फिगर आपको दी होगी. Instead of doing all this to calculate EMI, you take 10 lakhs and divide it by 3.51. ये कैसे है? You are paying 1 rupee. Suppose you pay 1 rupee every year. So what is the present value of those 5 rupees discounted at 13%, which is 3.51. Okay. How I done it? Formula just to show you. Okay. Present value of the annuity. Okay. So rate is how much? 13%. NPR is 5. Okay. PMT is how much? PMT is 1 rupee. Suppose I am taking. Okay. Fine. For 1 rupee. If suppose, assuming that you have to, I will take, suppose you give me 3 rupees 50 rupees, I'll give you 1 rupee every year in 5 years. It's like that. You give me 1 rupee, sorry, you give me 3 rupees 52 paisa, I'll give you 1 rupee in equal yearly installment, so you will get $5. Now, what is the return you are getting? 13%. तो आपको 13% पे हमने डिस्काउंट करा ना. आपने मुझे 3 रुपए 52 पैसे दिए, मैंने आपको 1 रुपया 5 साल में वापस कर दिया. हाउ मच रिटर्न यू आर गेटिंग? 13%. बिकॉज वी हैव यूज्ड 13% टू डिस्काउंट कैलकुलेट द प्रेजेंट वैल्यू. So same thing we applied here to find out the EMI or equated yearly installment here. The installment is coming to 2,84,000. Suppose you have to do it manually. Simply you don't have to do this. You just divide this. You will get the EMI. Now, after you have calculated the installments, okay. Now you have to calculate interest. Now for interest, look at the formula what I have used. Formula is 10 lakhs into 13%. So now since you are paying it, you are paying this installment at the year end. So company will say that we want 13% rate of interest on the right up to 10 lakh rupees because you are paying the first installment. So you pay 1,30,000 as interest, okay, which is included in your EMI. So what is the principal you are paying? 1,54,000, which is the balance, okay, which is if you just trace this thing. So it is 2,84,000 minus 1,30,000. So that means 1,54,000 is your principal. And what is the principal outstanding after 1 year? You are making a schedule, What you are doing is, you are making that, if ultimately you will have the figure 0. So you are paying, all this is interest which you are paying, and this is what you are paying. So ultimately, this is the installment you are paying, which includes the principal as well as interest. Isn't it? So you have to segregate it. Because interest is something which tax deductible. So you limit this is your profit loss account and reduce your taxation, isn't it? So you just joined it, this guy has purchased an equipment worth 10 lakh rupees. Okay. And he has two options, either to buy it outright, take a loan, or to take it on lease. So first we are, exploring if he is going to take it on own. He's going to take a loan from the bank. Okay. So he's going to pay 2,84,000 rupees as interest yearly installment. Is that clear? Now we come to, because interest is, if you're owning an asset, you're entitled for interest as a business venture. Now you're owning the asset, you're entitled for depreciation also. Please, here, watch. So I'm going to remove the arrows here. Then we go to the depreciation. Okay. Now the cost of the asset is how much? 10 lakhs. What is the depreciation rate? 15%, which is written here. Okay. So what will be the depreciation for the first year? Which will be 10 lakhs multiplied by 15%. So what will be the return value after first year? 8 lakh 50,000. Then 8 lakh 15,000 into again 15%. Okay. And then you will have the written down value. So you keep doing, ultimately our job is to calculate the depreciation, which is again a business expenditure, which he will be claiming. So this is all depreciation is going to claim, and this will be allowed him to has an expense. So we are just trying to find out which option is better. Okay. Now we come to the most important part. Very simple. Okay. This is something which you can do it anytime. Now, let's say as a business expenditure. Now you just add them up. How much you are paying as depreciation as well as, you know, so you are paying, basically the interest and depreciation, which are coming from the two slides earlier. Okay. So the amount is 2,80,000. Is that okay? Fine. Now, since your tax rate is 35%, so you're going to reduce your tax by 35% of this amount. Okay. Let's say this is your business expenditure, which you're going to claim. Okay. So you are going to pay 98,000 rupees tax, lower tax compared to if you have not claimed it. Isn't it? अगर आपने claim करोगे आपका 98,000 tax बच जाएगा. Isn't it? So what is your cash outflow? Which means this money you are paying, this is your benefiting, getting by the income tax benefit. So what you are paying is this. 2,84,000 minus 98,000 is the benefit which you are going to get, because this is your business expenditure. And you are going to lower your taxation by 98,000. If you pay 2,84,000, actually from your pocket, how much is going? 1,86,000. Okay. Now, since you're paying it after 1 year, so the 12% is the discount rate which has been mentioned in the question. So you're going to say if you pay today, how much would the amount look like? So 1 rupee paid after 1 year at 13% discount is going to be 0.893. So this also number I will be giving you all these number in your exam as a separate. So if you can't do it in Excel, you can just multiply it with this and calculate the present value of all this. Now this is the present value of whatever you are paying. Okay, so you paid 7,60,000. Then after 5 years, you're getting 1 lakh rupees salvage value of the equipment. Okay, which is equivalent to 56,000 as on today. After 5 years, which you're getting 1 lakh, today's value is 56,000. So that means the present value of all the cash flow which you are doing is nothing but 7,09,000. Now, we'll go to the leasing option and say the similar exercise, but a very short version, and calculate what is the present value of the cash and compare where the present value is more. That means you're paying more. So let's go to the lease option. I'll just repeat it again. Okay, don't worry. You are paying a lease rental of 3,30,000. Okay, again this is a business expenditure. So you're going to take a tax shield. So that means your outflow in cash will be 2,14,500 per annum. Okay, the present value of all this comes out to 7,73,000, which is given here. So you can even calculate the present value at 12%. So I can just calculate here also by simply doing the formula. Go to the formula. Go to the recently used formula. Here I say this is basically the present value. Okay, the present value, the rate is how much? 12%. For discounting rate is given to us 12%. NPR is how much? 5. And how much you are paying? 2,14,500. Okay, and put a minus sign to get a answer. So this is 7,73,000. So that means the present value of all money which you are going to pay in installments worth 3,30,000, getting the tax benefit. So how much you are paying? If you have to pay everything today, it is equivalent to what? 7,73,000. Now compare the two. When you are buying it, you are paying 7,03,000. When you are buying it to lease, you are paying much more. So which option is better to acquire? So buying is better than leasing as per this question. Is that okay? Have you got it? So here, what you need is all this information. If you do it manually, then you would be needing, these numbers, okay, to calculate the present value. So these numbers will be provided in your question. Okay, I'll share the question, a similar question on your WhatsApp group where all the numbers are given. Okay, the question will be different, but You can just solve it. If we have to do it manually, it's not a difficult thing. Okay. And you will be given this EMI number, 3 point. So number will be different in the exam. So you have to just divide and calculate the EMI. Okay. So have you understood all? Huh? Cash flow. Yeah. या पीवी फैक्टर हाँ ये बताते हैं देखो क्या है सी हाउ आई कैलकुलेटेड दिस इज 1 rupee if you are giving suppose if I'm giving you 1 rupee after 1 year okay you say give me 89 paisa now because I'm going to get 12% anyway interest on whatever you give so it is worth 89 paisa today okay so what we do is we can just go and calculate the present value so please look at here rate is how much your earning is 13%. So you can earn 12%. If I give you money today, you can earn 12%. Okay. And how much is the period? 1 year. What is the future value I'm going to give you? -1. Okay. Fine. You are going to give me 1 rupee. I'm going to give you from my pocket 1 rupee is going. Okay. So I'm paying one. So I put it here. So it is 0.893. Look at this. So 1 rupee equivalent paid after 1 year, today worth is 0.89 if you can earn 12% return on it. Whatever is your opportunity cost of capital. Now, if the business is earning 12% return, so they are going to use that. If the cost of capital is 12%, they're going to. If the cost of capital is 15%, they're going to use that. So it all depends on business to business, the discounting factor. Fine. Is that okay? Whatever opportunities you have, investing opportunities. Suppose you can put it in only a fixed deposit, then your cost of capital, your return would be only 6%. You use the discount rate of 6%. Okay, it depends upon the cost of opportunity, cost of capital. Okay. PV of the annual value by simply multiplying. Okay, just look at this. What I have done is I just multiplied this 1,86,000 with this amount and I got it. Okay. It is just simply multiplying the present value 0.89 into 1,86,000. So if you pay everything today, everything, how it look like, that means you're paying today. Whatever you're paying, 5 installments, if you pay everything right today, it is equivalent to 7,09,000. If here in the lease, if you pay everything today, it is 7,73,000. So now you say, okay, if I pay it say today, it is 7,09,000 in case of debt. In case of lease, it is 7,70,000. So then you take a call whether you want to pay more or less. But technically speaking, the option is better to buy it on of your own by taking a loan. Normally, it will happen if you are a good customer of a bank. The bank will give you the rate of interest, which will be far better than the leasing option because leasing options are little slightly costlier most of the time. But many times it may work in your favor also. Fine. Okay. Because it is much easier, you just approach to the lessor, he'll just give you the asset next day. But if you take a loan, it may take 3 months to get the loan approved and get the equipment. So you say, let me just not waste the time, buy the equipment now because time is more essence. For 3 months, I can do a lot of things. Yeah. Huh. Suppose you're taking an asset from someone. Okay. Now, first of all, you're taking an asset on lease. Okay. The lessor has a right to come back and take the asset from you in case if you fail to pay the EMI. Okay. But definitely the lessor will say that I need some more, another guarantee or collateral he may ask for. Of course, the bank may act as a lessor as a, as a financer for you or a lessor. So he may say, okay, that you have to or it can be on your personal guarantee itself. Like when I buy a car, I've taken a loan, so I've not given any collateral to the company, bank, isn't it? When you take a car loan, the the banking company is not to ask, will not ask a collateral for you. I'm just saying that. Okay, fine. So it's a huge equipment worth into 100 crores. So they may say, okay, create a charge, first charge for this asset. For me so that I can come and sell it. Whatever, I mean, legally he wants to do, protect himself, he can do that. Because this asset will not appear in the balance sheet of the company. But now, as per the Indian or international accounting standard, even if you buy a asset on long lease, virtually, actually, you are the owner. Okay. So you have to capitalize that asset in your balance sheet. It's now the requirement as per the Companies Act 2013. But it doesn't, as per income tax, you can always claim this because income tax and companies act two different. Okay, for making your income tax balance sheet and companies act balance sheet are two different. Okay, fine. Is that okay? Hmm. Yeah. Asset is itself a collateral. Yeah. Okay, just hold on. I'm just pausing the